Hi everyone, welcome back. Now let's continue our discussion on calculation of ECL. Before we move further, I would like to actually show the formula for calculation of ECL on off-balance sheet exposures as well. Reason being, in the previous lecture, we were calculating ECL on on-balance sheet exposure or on a loan that I had given, which was an on-balance sheet asset. Now, in case of an off-balance sheet exposure, there were two examples that I had given you. One was that of a financial guarantee. The other was that of a loan commitment. The formula remains the same. For in case of a financial guarantee, the ECL is calculated as exposure multiplied by probability of default multiplied by loss given default. If you recall the example that I had actually given in the previous session, the example was that my friend had taken a loan from you. You had given a loan to my friend, and I gave a guarantee to you that if my friend defaults, I would actually pay you the money. You gave a loan to my friend, and if my friend does not pay you the principal back, then I will actually make good that amount. I would actually pay that amount to you. Now over here, when we are using the probability of default, the probability of default that I will actually use will be the probability that my friend would actually default. All right, what is relevant for me is the probability that my friend would actually default. The exposure is obviously the amount of loan that was given. The loss given default is the loss that I would incur if the default actually happens. What I would like to emphasize is the probability of default is going to be the PD the probability that my friend would actually default. That would be recognized as a provision in my books of accounts. I, as a guarantor, will recognize ECL in my books of accounts based on this particular formula. That was one thing that I wanted to communicate on financial guarantees. The second part is on off-balance sheet loan commitments. How do I calculate ECL on off-balance sheet loan commitments? The formula broadly remains the same. There is one new term that gets introduced, which is credit conversion factor. We had EAD, PD, and LGD. Sorry, although this does not look like L, it is actually L. We had the same three inputs earlier as well, EAD, PD, and LGD. The new input that we're having over here is credit conversion factor. Now, what does a credit conversion factor mean? If I'm giving you a commitment that you can come to me and take a loan at any time in the next 1 year, what credit conversion factor is doing is it is trying to apply the probability that you will come and take a loan from me. All right, let us say the exposure is 100 million. And if we believe that there is a 60% chance that you will come and take the entire amount as a loan, we are multiplying that 100 million with 0.6, making my total exposure as $60 million. All right, so basically multiplying it with credit conversion factor is a way of converting off-balance sheet exposure into on-balance sheet. Because remember, I will always incur a credit loss only if I actually give you the money. I am going to incur a credit loss only if I give you the money. All right, so I'm going to incur a loss only after it becomes an on-balance sheet exposure. Therefore, what I'm going to do is I am using CCF factor to convert my off-balance sheet into on-balance sheet. The CCF of 60% means that there is a 60% chance that this $100 million will actually be drawn down by you. All right, the CCF is trying to actually convert the off-balance sheet into an on-balance sheet exposure. And then we multiply it by PD and LGD as we actually normally do. This CCF factor is not only used for calculation of ECL, but it's also used in a number of other places, more in terms of banks' regulatory calculations. Wherever a bank is required to calculate its RWA and so on, a bank is actually required to convert such off-balance sheet exposures into on-balance sheet exposures by using CCF factors. That is with regard to calculation of ECL on financial guarantees and on loan commitments. Moving on, IFRS 9 and Ind AS 109, they require all exposures, be it on balance sheet or off balance sheet, are required to be classified into 3 stages: stage 1, stage 2, and stage 3. I repeat, all exposures, whether on balance sheet or off balance sheet. When I say on balance sheet, I'm referring to assets like debtors, loans and advances, investment in bonds, and so on. On balance sheet and off balance sheet exposures like financial guarantees and off balance sheet commitments, they are required to be classified into 3 stages: stage 1, stage 2, and stage 3. On day 1, all exposures will be classified into stage 1. Whenever I'm originating any loan, whenever I have any asset being recognized for the first time, or whenever I have any new off-balance sheet commitment or guarantee that I'm entering into today, all such items will be classified into stage 1 on the first day. All right, whenever there is any new loan or whenever there's any new agreement which I'm signing, they will all by default fall under stage 1 category. All right, there is an exception which is of purchase or originated credit impaired, the POCI that I spoke of in last class, which I did not elaborate in the last session either. They do not fall into stage 1, but I'm not going to talk about POCI right now. We will deal with POCI separately. All assets, as a general statement, they are going to fall under stage 1. Assets or off balance sheet commitments on the first day of recognition, they will fall under stage 1. So all on balance sheet and off balance sheet exposures on the first day, they fall under stage 1 category. At each reporting date, which is after the first date, at each balance sheet date or each reporting date, again, I'm supposed to evaluate and classify those exposures under one of these 3 categories. I repeat myself. On the first day, let us say I've given you a loan of $100 million. Continuing the example of loan to Mr. X, I have a loan of $100 million that I gave, let's say today. All right. Today is, let us say, the 13th of January 2022. 13th January 2022, I have given a loan to Mr. X, and that is my on balance sheet exposure of $100 million. That will by default fall under stage 1 category. It is going to fall under stage 1 category. At each reporting date, all right, say I have to prepare quarterly financial statements on each reporting date, which means after 13th of January, my first reporting date happens to be 31st of March. On the 31st of March, I again have to classify the same loan under one of these 3 categories. I have to again re-evaluate. I have to recheck as to which category will the loan fall under. Will it fall under stage 1, or will it fall under stage 2, or will it fall under stage 3? Now, how do we check that? I will say that if from 13th of January to the 31st of March, if there is no significant increase in credit risk, I repeat myself, from the 13th of January until the 31st of March, if I say that there is no significant increase in credit risk, then they will continue to fall under stage 1. If there is no significant increase in credit risk, they will continue to fall under stage 1. If there is a substantial increase in credit risk, all right, if from 13th of January till the 31st of March, if there is a substantial or significant increase in credit risk, it will fall under stage 2. All right, if there is a significant increase in credit risk, it will fall under stage 2. Stage 3 is a different category. I will deal with it later. All right. So I've discussed about stage 1 and stage 2. Credit risk, remember, is the risk that the counterparty may actually default. All right. So if there is no significant increase in credit risk since its inception, it will fall under stage 1. If there is a significant increase in credit risk since its inception, it is going to fall under stage 2. Stage 3, we'll discuss it as we move further. All right. So at every reporting date, all right, let us say this loan to Mr. X on 31st of March, I think that there is no increase in risk. All right. The risk that I initially had, almost I have the same level of risk even now. Then it will fall under stage 1 again. All right. On 31st of March, I will again classify it as stage 1. On 13th Jan, I classified it as stage 1. 31st of March, again, I'm classifying it as stage 1. Again, I will move to the next reporting date, 30th of June. Let us say 30th of June, because I'm preparing quarterly financials. On 30th of June, I will again re-evaluate whether this loan to Mr. X needs to be under stage 1 or needs to be under stage 2 or needs to be under stage 3. If again, what I will do is I will again compare from 13th January to 30th of June. I'm not going to consider 31st March, which came in between. I will again start my comparison from 13th of January till the 30th of June. Is there any increase in credit risk? Is there any significant increase in credit risk? If the answer to that is yes, then on the 30th of June, I will classify it as stage 2. If the answer to that is no, then I will classify it as stage 1. All right. If there is an increase in credit risk since its inception, what I'm trying to emphasize is on the word inception over here. I am focusing on the increase in credit risk or no increase in credit risk from day 1, which is the 13th of January. I am not looking from 31st of March to 30th of June. I am looking from 13th of January to 30th of June. Let us say again, there is no significant increase in credit risk. So 30th of June also, it will be under stage 1. Similarly, 30th of September, again, I will evaluate from 13th of June to 30th of September. If there is no significant increase in credit risk since 13th of January, then it will fall under stage 1. If there is an increase in credit risk from 13th of Jan to 30th of September, I will classify it as stage 2. All right. So my comparison is always going to be from the date of inception until the 30th of until the reporting date, which in this case is 30th of September. Now the question is, why am I even classifying it into 3 different stages? What impact does it make? So we had the formula earlier of ECL being equal to EAD multiplied by PD multiplied by LGD, right? If it is a stage 1 exposure, then this probability of default will be the probability that Mr. X will default in the next 12 months. All right. So although the loan is of 5 years, the loan in the previous example that we had taken was a loan of 5 years. Although the loan is of 5 years, if it is a stage 1 exposure, I am not going to take the probability that Mr. X will default over the next 5 years. I am only going to be bothered about the probability that Mr. X is going to default in the next 1 year. I'm going to ask you, what is the chance that Mr. X will actually default in the next 1 year? Obviously, the chance that Mr. X will default in the next 1 year is going to be less than the chance that Mr. X will default over the next 5 years. The probability of default the probability that Mr. X will default over the next 12 months is going to be lower than the probability that he will default over the next 5 years. Because obviously, as the tenure rises, the chance that Mr. X will default will increase, right? So basically, if it is a stage 1 exposure, I am basically getting a benefit. I am getting a benefit from a ECL recognition point of view, that I will be recognizing lower amount of ECL, because this PD is going to be a smaller PD. It's going to be a smaller PD, and therefore my ECL will be on the lower side, and that is basically a benefit for me. All right. So if an exposure is classified as stage 1, then I will only calculate 12 months expected credit loss. All right. Why is it being called as the 12 months expected credit loss? Because I am taking the probability that the counterparty, the probability that Mr. X will default over the next 12 months is only being considered. All right. The probability that Mr. X is going to default over the next 12 months is what I'm going to be bothered about. I'm ignoring the probability that he might default beyond the next 12 months. All right. So on day 1, on 13th of January, when I gave the loan, I said that by default, all exposures will be classified as stage 1. On 13th of January, when I gave that loan of $100 million to Mr. X, by default, it is going to be classified as a stage 1 exposure. So on day 1, when I calculate ECL, the ECL is going to be EAD of $100 million multiplied by probability of default of only the next 12 months. I'm going to take only the 12-month PD multiplied by the loss given default. So my ECL value on day 1 is going to be slightly on the lower side. It's going to be on the lower side. Similarly, on 31st of March, let us say if the exposure is still continued to be classified as a stage 1 exposure, then the probability of default will again be the probability that he will default in the next 12 months. All right. Again, therefore, I'm not basically penalizing myself by recognizing a massive amount of ECL, but I'm recognizing only a small amount in the form of ECL. The IFRS 9 is not being highly punitive, but it's only asking entities to recognize a small amount of ECL. That is with regard to stage 1 exposures. As long as it is in stage 1, the PD will be 12 months PD, and therefore the ECL is going to be called as the 12 months expected credit loss. If, let us say, an exposure moves to stage 2, all right, say on 31st of December, okay, I believe that there is a significant increase in credit risk. All right, obviously, this increase in credit risk, maybe you're thinking that it's a little qualitative or little theoretical. I will give you instances of how you can actually see whether there's been a substantial or a significant increase in credit risk. All right, say for example, hypothetically, I'm just giving you an example. On day 1, when I gave this $100 million loan to Mr. X, let us say Mr. X has a credit rating of say A, or A plus, all right. We've got these S&P credit ratings. Obviously, S&P credit ratings are for corporates. I'm just hypothetically saying that let's say we have Mr. X who's got a credit rating of A plus, all right. A plus is obviously a very good credit rating, all right. Hypothetically, I've assumed Mr. X is also having a credit rating. Say on 31st of December, Mr. X credit rating is now, let us say, B minus, all right. From A plus, it has gone down to B minus, all right. In between, you had triple B, you had double B. It has massively fallen down, probably because its financial performance was weakening, or maybe the economic conditions of Mr. X's business was not great, and therefore the credit rating deteriorated significantly. If the credit rating is deteriorating significantly, you can think of it as a significant increase in credit risk, all right. This is only an example for me to communicate the understanding of what significant increase in credit risk actually could mean. All right, there can be many other circumstances. The text of IFRS 9 and Ind AS 109 also gives some examples. They also give some examples of what qualifies to be a significant increase in credit risk, which we will actually see in some time. Since there is a significant increase in credit risk, I will now classify it as a stage 2 exposure. I'm now going to classify it as a stage 2 exposure. And when I'm calculating the ECL is going to be exposure at default multiplied by lifetime PD. All right, it's going to be multiplied by lifetime PD multiplied by LGD. What does this lifetime mean? This lifetime basically means that I am now no longer interested in the probability that he will default in the next 12 months. I am not interested in the probability that he will default in the next 12 months. I am interested now in the probability or the chance that he will default in the remaining tenure of the loan. All right, with the loan was 5 years, let us say almost 1 year has elapsed because I gave the loan on 13th of Jan. We are now on 31st of December. 1 year has passed by. I am now going to be interested in what is the chance that he might default over the next 4 years. What is the chance that Mr. X might default over the next 4 years is what I'm actually going to be interested in. That is the reason it's called as lifetime probability of default. All right, it's the lifetime probability that Mr. X will default over the next 4 years or over the next remaining life of the loan. Obviously, lifetime PD is going to be greater than 12 months PD. Lifetime PD is going to be greater than the 12 months PD. And therefore, when it moves to stage 2, your ECL is going to shoot up. Hypothetically, if I can take as an example, we saw that in my original example, I think I gave you the input such a way that this was coming to 2.1 million. I gave you a probability of default of 7% and a loss given default of 30%. Let us say this was the ECL on day 1. Let us say this was the ECL until 31st of December. Until the 30th of December, the ECL, let us say in the books of accounts, was 2.1 million. all right, all of a sudden the PD will now no longer be 7% because that 7% was the PD that he was the probability that he will default in the next 12 months. Now let us say PD is going to become, I'm just giving you some random numbers. Let us say it becomes 20, or maybe for me, for easy calculation, I don't have a calculator. So let us say PD becomes 20%. So my ECL is going to be $100 million multiplied by 20% multiplied by 30%, which is the loss given default. And this is now $6 million. My ECL at 31st of December 2022 has become $6 million. My books of accounts, all right, my books of accounts now has an ECL of only $2.1 million. My books of accounts has got an ECL of only $2.1 million. Therefore, increase in ECL is $3.9 million. All right, with the increase in ECL is $3.9 million, and this is obviously going to be a P&L debit. Okay, so the $2.1 million originally also was a P&L debit. This is now the incremental P&L debit. All right, after I recognize the provision of $3.9 million, my accumulated provision becomes $6 million, and this $6 million is going to be reduced from my asset account, and I will have a net exposure of 94 million. 100 million minus 6 million, I will have a net exposure of $94 million. That is about stage 1 and stage 2. All right, stage 1, no significant increase in credit risk. ECL will continue to be calculated using 12 months probability of default. Stage 2, there is a significant increase in credit risk. ECL will now be calculated using lifetime PD, and therefore this ECL is going to be called as lifetime ECL. The first one was called as 12 months ECL. This is going to be called as lifetime ECL. All right, I just want to clarify one more thing. Even if there was no significant increase in credit risk over here, the PD could still change. All right, please don't think that the 7% is going to be a constant probability of default. Even if there is no significant increase in credit risk, where the exposure is continued to be classified under stage 1, still the next 12 months probability of default could actually change, and there can be a change in ECL. There is no necessity that ECL will remain at $2.1 million. ECL, although the exposure is under stage 1, ECL can still keep changing, and that will go to P&L either as an expense or as an income. If ECL increases, it will be an expense. If ECL decreases, it's going to be considered as an income. All right, that is with regard to stage 1 and stage 2 exposures. So under stage 1 exposure, we are calculating 12 months ECL, where the PD that we use is actually the 12 months PD, the probability that Mr. X will default in the next 12 months. Under stage 2, I am calculating the lifetime ECL, which means I'm going to use the lifetime probability of default, which is nothing but the probability that Mr. X will default over the remaining life of the loan, over the remaining tenure of the loan. Now remember, when I'm classifying the loan to Mr. X, either under stage 1 or under stage 2, I am not doubting. I'm not doubting that Mr. X will actually default. All right. I still believe that Mr. X will actually repay money to me on time. All right. Remember, just because his credit risk has increased, it does not necessarily mean that he is going to default. All right. I still believe that there is a great chance that he might actually repay my money back to me. For example, over here, I took the probability of default as 20%, which meant that I still believe that there's an 80% chance that he's actually going to repay that entire amount to me. There's an 80% chance, which means there's a huge chance that I will receive my money back on time along with principal, along with interest. All right. So under stage 1 and stage 2, I am not believing that the Mr. X is actually going to default on my loan. Yes, there has been an increase in credit risk, but despite that increase in credit risk, I still believe that X will repay the money back on time to me. But if I believe that there is now a chance that Mr. X will default, if on a reporting date, if let us say after 31st of December, I had the next reporting date of 31st of March 2023. All right, 31st of December 2022, I classified him as a stage 2 exposure. 31st March 2023, I now believe that maybe there is a likelihood that default may occur. All right, there's a likelihood that a default may occur, or let us say a default has already occurred. He has already defaulted on an interest payment. Interest was supposed to be received by me in the month of January, but he has already defaulted on it, which means he has not paid me money, or he has paid me money, but I now believe that there is a significant chance, or there is a likelihood that he will actually default on the future payments. Either a default has already occurred on one of the past payments, or I now believe that a default may occur on one of the future payments. Then I will classify it as a stage 3 exposure. If I believe that a default has already occurred or a default may occur in the future, I will then classify it as a stage 3 exposure. There are few other circumstances under which we will classify it as stage 3, which I will show as we progress ahead. I'll show you the actual text of IFRS 9 when it says that exposure should be classified under stage 3. But basically, stage 3 is called as a credit impaired position or a credit impaired asset, where a default has either occurred or a default is likely to occur in future. The calculation of ECL does not change from stage 2 to stage 3. I will still continue to calculate lifetime ECL. The way I calculated stage 2, I continue to calculate ECL under stage 3, but obviously on each reporting date, I will review my parameters. I'm going to review my parameters on each reporting date. I will recheck whether the probability is now slightly on the higher side. I will obviously recheck the loss given default also. Maybe now I believe that the loss that I might incur might be 60%. My recovery rate might only be 40%. I might change my parameters, and obviously if I change my parameters, my ECL is actually going to change. All right, so in terms of calculation of ECL under stage 2 and stage 3, there is no change to the fundamental formula. We use lifetime PDs in both the places. Obviously, there can be a review of the parameters that have actually been used. Then the question is, why do we have a different classification between stage 2 and stage 3? One difference that I already explained is, when an exposure is classified under stage 2, I'm still not believing that there will be a default. All right, I'm still not believing that there will be a default. Yes, there has been an increase in credit risk, but I still don't believe that a default may occur. But once I move it to stage 3, it means I as an entity, I believe it that there might potentially be a default, or a default has already taken place. That is one difference. The other difference is with regard to recognition of interest income, which I've not covered. All right, I skipped interest under all the three boxes. The difference lies in the way I'm going to calculate my interest income as well. Remember, under amortized cost and FVOCI, we had calculation of interest using the effective interest rate. We saw that interest is supposed to be calculated using the effective interest rate. Under stage 1 and stage 2, I am going to calculate interest on my gross exposure or the gross carrying amount. I will calculate my interest income on the gross carrying amount or the gross exposure, which is nothing but my purchase price plus transaction cost. That becomes your initial recognition, and you calculate interest on that, right? But when it moves to stage 3, I will calculate interest on my net carrying amount, which means I will apply the effective interest rate not on the opening gross balance, but I will apply my effective interest rate on opening gross minus the allowance for ECL. So I am going to calculate my net carrying amount, and my EIR, the effective interest rate, I will apply it on my net carrying amount rather than applying it on the gross carrying amount. All right. In case of stage 1 and stage 2, the effective interest rate, I will straight away apply it on the opening balance, and the opening balance will be without deduction of ECL. Whereas over here, once it moves to stage 3, the interest will be calculated on the net opening balance, which is after deduction of ECL. That is difference number 2 between stage 2 and stage 3 exposures. First difference is the default not likely to occur under stage 2, but likely to occur under stage 3. ECL interest calculation will be on a gross basis under stage 1 and stage 2, but it will be on the net carrying amount under stage 3. These are the two differences between stage 2 exposures and stage 3 exposures. Now, if you actually carefully think of it, more from an Indian point of view, RBI actually mandated banks to classify all its exposures into three broad categories: standard, substandard, and non-performing assets or NPAs. There could be more classifications, but broadly, the asset classifications were standard, substandard, and NPAs or non-performing asset. And RBI's provisioning norms required banks to recognize provision for doubtful advances on all categories of loans. It required banks to recognize provision on standard, substandard, and non-performing assets. All right, just that the percentages used to increase. For standard, it used to be a lower percentage. Substandard, it used to be a higher percentage. NPAs, it used to be a much higher percentage. And within that also, collateral, if something which has collateral will be of a lower provisioning percentage, something which does not have collateral would be of a higher provisioning percentage. If you actually try to think of it, almost what Ind AS 109 has done is it has kind of just replicated what RBI already required banks to do. It's not an absolutely new concept that has come into India. RBI has always mandated banks to classify its assets into three broad categories: standard, substandard, NPAs. Standard is equivalent to stage 1, substandard is similar to stage 2, NPAs or non-performing assets are where default has occurred or is likely to occur, which is similar to stage 3. I'm not saying that they're exactly one and the same, but intuitively, I'm just trying to tell you that they're almost the same. Just like RBI was increasing the provisioning percentage when it moved from standard to substandard to NPAs, over here also we are increasing our provisioning percentage when we are moving from stage 1 to stage 2 to stage 3. RBI, if I recall it correctly, did not permit recognition of interest income on NPAs. On NPAs, RBI never permitted recognition of interest income. Over here, under stage 3 exposure, you're permitted to recognize interest income, but you're recognizing it on the net carrying amount, which is after you reduce ECL. All right. So you had an opening balance of $100 million. You reduce ECL, and in the net amount you're allowed to recognize interest income. All right. I'm not saying that they're exact replica of RBI's prudential norms. Obviously not. But I'm just trying to intuitively tell you that RBI's prudential norms were also almost the same as what IFRS 9 or Ind AS 109 is asking us to do. This was only for you to better appreciate the logic. When Ind AS 109 was implemented in India, Ind AS is not applicable for banks. All right. So if you actually go through SBI accounts or ICICI bank accounts, they do not apply Ind AS. All right. Ind AS is not mandatory for banks, but it is mandatory for NBFCs. It's a mandatory for non-banking financial corporations. And obviously, a bank's balance sheet and an NBFC's balance sheet are almost the same from an asset side. An NBFC is also engaged in giving out loans. A bank is also engaged in giving out loans. When NBFCs actually adopted Ind AS 109, they moved from RBI's prudential norms to Ind AS norms. All right, Ind AS being stage 1, stage 2, and stage 3. RBI's norms were the old norms that were applicable. They moved into Ind AS norms. All right, once they move into Ind AS, RBI's prudential norms are no longer going to apply to them with regard to provisioning, because they have to create provision under Ind AS 109. When they moved from the RBI's norms to Ind AS norms, then there were few NBFCs which had more amount of provision. They had more amount of provision as per RBI norms, and they ended up reversing some amount of provision when they actually adopted Ind AS. All right. They earlier, based on the RBI norms, they accumulated more amount of provision and they ended up reversing it. All right. These are those NBFCs which have great corporate governance. These are the NBFCs which had great corporate governance. They were always a little conservative in terms of investment of capital and so on. So they had higher amount of provision, and they ended up reversing some provision when they adopted Ind AS 109. There were few other NBFCs which had lower amount of provision. when they were following RBI's prudential norms, but they had lower amount of provision and they had to increase their provision when they moved to Ind AS 109. All right, there was some lower amount of provision and they had to increase it. These NBFCs were slightly the ones which had lower corporate governance, or they had some, they were a little much more flexible in granting loans or in disbursing loans to borrowers. All right, so what I'm just trying to say is, on an average, all right, if I remove the extremes, on an average, probably you can pass a statement that RBI's prudential norms almost resulted in more or less the same amount of provision that Ind AS 109 ultimately ended up recommending. All right, there was almost more or less the same that Ind AS 109 was actually recommending. A disclaimer is that I have not personally gone and done any research on NBFC's provisioning before and after adoption of Ind AS 109. This is more what I've actually seen or read somewhere, and I'm just passing on that communication to you guys. I have personally not done any kind of research. That's a disclaimer. We're not yet done with ECL. We have still more to discuss, but that's it for this session. Bye-bye. Thank you for joining.